Okay, I have 3 o'clock, so let's get started. Hello, and welcome to the Post-Fire webinar series. My name is Carrie Berger, and I'm the manager of Oregon State University's Extension Fire program. Some of you may already know, but for others that don't, the fire program is a new program in Extension, and we are gearing up as we speak to help facilitate landscape scale cross-boundary management projects on the ground, and also to provide education and outreach to all Oregonians. So much like our forestry and natural resource extension colleagues, the fire program team will be living and working in communities throughout Oregon. For this post-fire webinar series, we have focused on impacts to forestry and natural resources on your property. And we've provided you with information on an after the fire checklist, hazard tree assessment, erosion, tree mortality, salvage logging or harvesting, and restoration. Information about these webinars that we've hosted in the previous weeks can be found on the fire program website, and the recordings can be found on the Forestry and Natural Resource Extension YouTube channel. My co-host, Mike Clousey, is adding these links in the chat box, and I will also provide resources to you in a follow-up email. I want to thank Mike for helping me co-host this webinar today. Mike Clousey is the Director of Forestry with the Oregon Forest Resources Institute. Thanks so much, Mike. So, oops. Oh, excuse me for a second. Oh, well, shoot. I had a beautiful picture, but you'll just have to envision it in your minds. I want to acknowledge here that many of you have lost everything to the wildfires that occurred this year. It is not our intention to undermine the severity of those losses, but to acknowledge with respect and as much understanding as possible. I wanted to direct your attention to a photo which depicted the scene after the wildfire with a home destruction, but a beautiful garden and 2 people searching through this beautiful garden, green vegetation, and these beautiful heirloom tomatoes. So after the fire, these folks came back to their property to harvest the remains of their garden, including that special heirloom tomato I just talked about. And like those special tomatoes, you are also survivors. And when the time comes, you will plant yourself again and grow stronger and better than before. So thank you for being on the line with us today. So before we begin, I have some logistics that I'd like to quickly cover. The session is being recorded, and all webinar recordings can be found on the Forestry and Natural Resources Extension YouTube channel. We are also streaming live on the Extension's Facebook page. Okay, so for all you on the webinar, your audio has been muted. If you're having audio troubles and are connected to your computer's audio, I suggest hanging up and dialing in with your phone. You can always post a question in the chat window if you are having technical difficulties, and Mike Clousey will be monitoring the chat window and can help you out. Thanks again for that, Mike. If you have a question on the information that is presented, please type your question into the Q&A window. We plan to pause after the presentation and have time for question and answer. And then finally, you can adjust how you view the presenters by going to the upper right corner of your screen. You might choose to see all presenters at once or just the person who is actually speaking. So I'd like to introduce our speaker today, my colleague, Tammy Cushing. Tammy is Oregon State University's Extension Specialist in Forest Economics, Management, and Policy, and she is also the Starker Chair in Private and Family Forestry. Again, if you don't catch all the information presented, don't worry. I'll provide all the resources mentioned during this webinar on our fire program website on the webinar class guide web page. And like I said, I'll even follow up with that email just to be sure you get the information. So, okay, let's get started. I'm going to stop sharing my screen. And Tammy, whenever you're ready, go ahead.
Great, thank you, Carrie. Let me get my screen shared here. Beginning. All right. So good afternoon, everyone. Thank you for joining us today. We're going to talk about some tax considerations for those of you that have been affected by the wildfires in the West this year. But a lot of this information is also applicable for other natural disasters. This stuff could be applied to the ice storms that we had in 2014 here in Oregon, but it could also be applied to those who've dealt with hurricanes or tornadoes in other parts of the country. So with that, we'll go ahead and get started. I am going to pause at one point and allow us to kind of catch up with some questions just in case we need to go forward. So just kind of a standard introduction anytime we talk about taxes, it's really important to mention that tax law is very complex. You're going to see just a smidge of how complex that is today as I try to navigate different rules for different categories of people. But because it's so complex and it's going to hinge on a ton of details, this isn't going to go into a lot of detail, unfortunately. We do have some resources we can point you to. And of course, as a specialist here at Oregon State University, I'm available for questions, or if you need to point a tax preparer to me to ask some specific questions, we can make those arrangements. All this information does change. It changes whenever they feel like changing the rules. Sometimes we can foresee that happening, and other times we cannot foresee that happening. I'm going to tell you today how we know it to be. And then, of course, if I realize there may be some things that might change on the horizon, I might note that for you. I am going to stick, for the most part, to federal tax law today, with the exception of a section on some Oregon-specific property tax-related rules towards the end. I also want to mention that what we're talking about today, this should not be construed as tax advice. This is educational in nature, and in some cases, I am interpreting the tax laws to the best of my ability based on information I've received. Just to kind of give you a little bit of run of show today so you know kind of what the scope is of what I hope to cover with you. We're going to talk just at the beginning, really, what is a casualty loss and some of the rules regarding what a casualty loss is. We'll then go into this topic of basis, how to determine basis and allocate it. I want you to know that now, because I'm going to use that word in the casualty loss part. Unfortunately, with taxes, a lot of pieces kind of roll up on each other, and you use a term in one part that you can't define until a later part. So know that basis is going to come with a full definition for you. We'll then talk about whether you're going to have some gains and how we're going to deal with gains from sales related to some of the harvests, financial assistance, how to treat financial assistance from that you might receive, talk about reforestation, and then we're going to go into some of the Oregon tax considerations specifically related to small tract and harvest taxes. So with no further ado, let's really talk about what casualty losses are. And so specifically, the IRS says a casualty loss really is going to be something due predominantly to fire or storm. We're looking for that identifiable event. So I want to be able to open the paper and find that a tornado hit this spot this day, that there was a wildfire and it covered Oregon during this time period. So we're looking for that particular event. And I say that because something like a drought is a little bit harder to find the event. So with a drought, it tends to be a little bit more nebulous. It's stretched out. It kind of starts. Everybody kind of knows they're not getting as much rainfall, but it's kind of hard to nail down when the drought event actually occurred versus a hurricane, an ice storm, a fire event. So it's that identifiable event. It is usually results in sudden death. And so that's a very particular thing that we have to pay attention to. And the reason sudden is important, if you think about insects or drought specifically, death to the tree is not sudden in these cases, right? It's more of a prolonged death. So the tree is dying. That means you have time usually to do something about it, harvest the tree, if you will. in something like a wildfire or tornado or a hurricane, those trees get snapped or they're burned. And so it's that sudden event. When we say it's unusual, it means it's not a day-to-day occurrence. I know that it's really hard with a lot of these events to think of them as unusual. If you talk to somebody in the South and said a hurricane was unusual, they'd be like, no, it's not, it happens every year. We don't believe wildfire is unusual anymore. So it's really that it's just not a day-to-day, and that it's unexpected and that you can't anticipate it happening in that very particular location. While we know we are to increase risk of hurricanes in the South and of wildfires in the West, you don't expect it in any one particular area in a given year. So within casualty loss, there are these casualty losses that occur to kind of the business or investment property, and casualty losses that might occur to something that's more personal use property. And just to make it super clear in this case, we're going to talk about your house, household items, your personal vehicles, as being those personal use items. Now, it's very likely you've lost those items and they're associated with a casualty event, so they meet those definitions. The only way in the current tax code that you can take any loss in these personal use items is if it's in a federally declared disaster area. So we're looking for the president to make that declaration of a disaster area. In the case of Oregon, for the most part, the state of Oregon was declared a disaster area from the wildfires that occurred in the month of September. Most hurricanes result in a disaster declaration by the president. It usually takes an ask by the governor. So you're looking for some notification within your state that that has been asked for and has been approved. You can find a list of all the disasters that have been declared on the federal pages. With a personal use casualty loss, so again, your house, any of your household belongings, personal vehicles, if there's no presidential declaration of a disaster, then there is no allowable loss under the current code. And this is something that changed in one of the most recent changes to the tax code. If it's in the disaster area and it's a personal use casualty loss, you're going to figure out the actual loss, and then you're going to have to subtract $100, and then you're going to have to subtract 10% of your adjusted gross income. That's something very specific to these personal use items. Now, the focus today is not going to be on these personal use. I just wanted to kind of get this information out there because I realize that many of you that have forests also are going to have these issues with your personal use items. So I wanted to give you just a little bit of information on that. From here on, we're really going to focus on the forests and your forest land. All right, so if we look at the casualty loss, the rules that govern the amount of a casualty loss look at the lesser of the decrease in the fair market value of the property or the adjusted basis. Now, this category assumes that you haven't suffered a total loss, that there is some salvage or some decrease in value. And so you'd be looking for what was it immediately before the loss, what was it worth, and then what was it worth right after from a fair market value standpoint. And when we say fair market value, we're not talking about sentimental value, what I think it's worth. I might think my car is worth $20,000 and I try to sell it and nobody will give me more than a couple hundred for it. That's kind of an indicator of what the fair market value is. So we're looking for that decrease in fair market value right before and right after the event. So it's the lesser of that decrease. So in the case of timber, if I had mature timber, that decrease in fair market value could be fairly large. So we're going to compare that number to our adjusted basis. Now I'm going to talk to you about basis in a little bit, but basis for now is basically what you've paid for it or what you have invested in it. If it's your trees, what did you pay for the trees? What did you pay to get the trees in the ground? That's your basis starting point, and then there's some adjustments to it that we'll talk about later. The real sticker here is that it's the lower of those two numbers. And so for the majority of people in these casualty loss situations, unfortunately, the lower number tends to be the adjusted basis and not the decrease in fair market value. That is something that there is being fought for by different organizations to try to change that at the federal level. There is movement being made on that. We're hoping to see some vote on that in the near future. Unfortunately, that unless it's made retroactive, will not impact us. So for now, you're looking for the lower of those two numbers. Okay? I understand that's not welcome news for most of you. The loss is going to be calculated based on a record-keeping unit. So previously, there was a lack of clarity on what that record-keeping unit might be. What the loss was calculated on at one point. The IRS tried to have you calculated on an individual tree basis, but current regulations are telling us that it's based on a record-keeping unit. So if you have been treating your entire property as one unit, meaning you don't have separate financial accounts set up for different pieces of the property, then that is your record-keeping unit for your loss. If you're a larger ownership, and let's say you have 1,000 acres of timber, and you've separated that out into some more mature timber and some younger timber, and you've kept those in two separate accounts for record keeping, then those are going to be your record keeping units for the purpose of the loss. We'll talk a little bit more about those units later. So you're going to have that loss, the lesser of those two. If it's not covered by the insurance, and that's going to be what you're allowed to deduct. If you have some insurance coverage, if you're going to file for reimbursement, you're going to reduce the loss by any amount of reimbursement you expect to receive or that you do receive. So it's just making sure that you're only taking the amount that you're not compensated for. And normally you're going to take these losses in the year that the loss occurs. So in the case of our fires, you would take that loss normally on your 2020 tax return. But in a presidential declared disaster area, you can go back and do it in the year before. And what that does is allows to expedite receipt of some of those loss deductions so that you can get those tax savings back sooner so that you can use that to recover. So there is that recognition, but it has to be in a declared area. If you are in the situation where you have multiple owners, so multiple families maybe, or siblings that are joint owners with the property, you're going to allocate that loss that you've determined by the ownership share. So if my brother and I are equal partners in the property, then we're going to share that loss deduction down the middle. If though the way we had set it up was such that he was a 2/3 and I was a 1/3, then the loss would be split the exact same way. As far as the actual mechanics of taking the loss, you want to provide proof of your ownership, of course. You want to provide proof of the loss. And when I say proof of the loss, pictures are always a good indicator of proof of the loss. You also want to prove how much the loss was. So you would want to show, if you could, any decrease in fair market value. Maybe it's a picture before showing your standing timber right before. It doesn't have to be right before. It can be 3 years ago. You can show this big stand of timber, house in the background. A picture from the same spot today shows the house in the background in its current state, and the timber burned in front of it. Would be a good indicator of loss. And I apologize if I'm bringing up tough images, but this is what you have to do to kind of prove some of this. You're also looking to prove your basis in the timber. And again, we'll talk about what that is in just a minute. I understand that in some cases, depending on the scale of your loss, you may have lost the paperwork to document these things, to document your ownership, to document the amount of your loss or your basis. And the IRS has indicated previously with these kind of events that you can recreate as long as you are really making a good effort to show that documentation is justified. So what we also see sometimes is you're taking these losses, and these losses are greater than your income for the year, especially if you're retired or you've had a complete loss. This could trigger what is known as a net operating loss, or an NOL. Those get kind of complex, and I'm going to not cover that in detail today. So I would ask that you, if you're in the situation where it's going to trigger net operating loss, you might want to consult a tax preparer for further guidance. All right, so as we continue trying to think about what that loss amount is, you've done the lesser of the decrease in fair market value or the adjusted basis. You're going to take that loss and you're going to account for any salvage that you've taken that you've received. So if you are able to harvest the timber and you have harvested it, even if it's for less than what you should have gotten for it, you do need to take into account the amount of the salvage. If you did get insurance proceeds, similar situation. Now, you're not required to actually salvage. You're required to make some attempt to salvage, but it's not required for you to take pennies on the dollar just in order to get the salvage requirement met. But you should at least figure out if there's any opportunity for salvage. I think in the case of Oregon, with the wide scale damage that we had here, it is going to be hard to salvage in some cases, and that shouldn't be very difficult to show that you made some attempt. Both the salvage and the insurance proceeds, either one of those could actually make it so that you're actually going to show a taxable gain. This is one of the tough topics, right? First telling you that you may not have much of a loss, and then second actually indicating that you might have to claim a gain. And it's hard to think of a gain when you're looking at what could have been as a stand of timber that was going to bring in high dollars and now is bringing in minimal dollars, but it does indicate a gain. Regardless of the amount of gain, if you have a gain, you have to report it, and we'll talk about some of that as well, what that means. So if you have a gain, you can postpone that gain if you do a replacement within 2 years. And so there's some steps to take if you're going to look for replacement property. And so if that's the situation for you, make sure you talk to a tax preparer, look for further guidance on doing that postponement of gain. We're not going to get into that today. All right, so again, that starting point is the lesser of the decrease in fair market value or your adjusted basis. So let's see, we've got to talk about the pieces now because I keep talking about basis. So let's talk about how we're going to get basis. So basis, first off, is a measure of your investment in that asset. And I'm going to use big words, financial words, but what this really means is what did you have in it, right? If you bought it, you know that you paid something for it. That's very clearly an investment. Even if you didn't buy it, you are kind of invested in it in that you could have sold it and turned those proceeds into something else. And so we're going to continue to talk about basis as your investment in this asset. And we call it a capital asset. And for those of you who have a accounting background or tax preparation background, timber and land aren't really capital assets, but there are pieces of the code that allow us to kind of consider it and treat it that way right now. And as long as that stays the case, we're going to continue just to kind of call it a capital asset. So that capital asset is really just talking about the fact that it's productive, right? So the land is productive and it's your trees are productive and that they're producing more volume and therefore more wood for the future. So regardless of the fact we're talking about a loss or a gain, knowing your basis is going to be really important at the time of a sale or the time of thinking about that loss. If it's on a sale point, we're going to reduce the taxable gain, therefore you pay less taxes on the gain. If it's the loss, we need to know what you're limited to. And the basis is that starting point. So actually figuring out what that basis isn't anything special to forestry. Determination of basis is something that happens for all assets. You have a basis in your home. It's what you paid for your home and all the expenses associated with acquiring your home. So the same thing applies within forestry. And determination of basis is really a function of how you acquired the property. And so I'm going to lump a little bit today into these 4 categories of purchasing the property, inheriting the property, getting it as a gift, or going through some kind of exchange procedure. And so, like I said, none of this is specific to forestry. So I'm going to really just kind of focus today on purchasing and inheritance. The gift rules are a little bit more complex, and of course, exchanges are dependent on whether you had a taxable or a non-taxable exchanges. So we're not going to touch those today either. So we're going to start with this purchase property, mainly because I think if I asked most of you, you could think about what you paid for the property. I know what I paid for my home. I know what I paid for the total value of the property. So it's the total amount that I paid for it. It's going to include any attorney fees, commissions, sales taxes, all those expenses, and it's everything that I purchased at that time. So if I purchased land and there was land, there were buildings on it, there were trees on it, all that is in my original purchase price. And so you can find that amount. And the unfortunate thing in the case of trees or forest land or land in general is that this basis amount is not indexed. So we're looking for what did I pay for it when I got it. So if that was 1990, 1970, or last week, it doesn't matter. It's what did you pay for it at that point in time? And that's the number that we're going to work off of for our basis. And for some reason, if you don't know these numbers, we're going to talk about that as well, what we're going to do to kind of figure out these numbers. So in the case of a purchase property, if you got it in the past and you don't know the numbers, you can go back and try to find what that transaction was. In a lot of cases, these sales are registered. You can go back and find the records. And so what you're looking for is some record of what the purchase price was. If you receive the property through an inheritance, what happens in the inheritance system, right, in the estate system, is when someone dies, that property is going through the estate tax system or the inheritance system in the state, and the basis is equal to the fair market value at date of death. And so that is, as a general rule, the date of death valuation is what you're looking for. And in some cases that may be official, you may have this real big official valuation of it, or you may have an unofficial valuation of it, or you may not actually have anything. And so regardless, if you got this property, if my grandmother died and I acquired the property, I want to look back to when grandma died, and that is the basis at that point in time is what I'm looking for. So what were the assets worth at that time? So again, at date of death, or in some cases, the executor of the estate picks this alternate valuation date, which basically means everything is reevaluated at a different date. Usually it's because something big happens, like a stock market fluctuation, usually downward. And so all assets are then revalued at that point in time. So you're looking for what date are you looking for a value, and then what were those things valued at that point in time. We call this a step-up basis because we're bringing the basis up from when grandma purchased it up to that current time when she passes away. And then in the case of farm, ranch, forest land, a special use valuation is something that allows us to reduce the value to bring it, instead of the fair market value, it comes down closer to what we would call a current use. So for ag or forest purposes, that's a special valuation, and you want to find out if that was used because that would change the value as well. So regardless of whether you got it through an inheritance or a gift or an exchange or you bought it, no matter how you got it, you want to take that basis or that purchase price and you want to split that out or allocate it out among everything that you got at that point in time. So if I buy that property and it has land, it's got some merchantable timber on it, meaning I can take that timber to the mill and they will pay me for it. Maybe I have some premature timber on it. So I've got some 10-year-old stuff that nobody's going to pay me for, but obviously I paid something for those 10-year-old trees because they're 10 years into their growth cycle. So they are worth something. And I may have had some buildings on it. So whatever I have on there, I want to take that total purchase price or that fair market value at date of death, and I want to split it out among all these assets. And the reason I want to do that is in case something happens to one of those assets. So if I had property with all these assets on it and just a building burns, so my house burns down, I want to know what the house was worth, what the basis of the house was. If it's just the timber, if it's an insect infestation, or it's a tornado hits just part of my timber, I want to be able to know what that particular piece, what I paid for it, so that I can go through the calculations to determine my loss or my gain if I harvest a piece of it. So we want to split all that basis out. So again, if I look at that initial purchase, and we're going to think like we just did this because this is the easiest time to think is when I just did it. I know my purchase price, and I'm going to split it out among the assets. If I'm looking at land, it's really kind of the comparable sales. What would bare land in the area kind of sell for? And then if it's timber, I'm looking at what are the timber market prices along with the volume and the quality and the species. So it's got a lot of pieces into that timber part. But I'm going to start putting together the pieces and figure out what they're each worth individually. So I'm going to construct, if you will, a fair market value for all the things that were on my property, because I don't actually know what I paid for the pre-merchantable timber or what I paid for the building. I know what I paid for all of it. Now I need to figure out, what did I pay out of that whole piece of the pie, that whole pie, what did I pay for that one piece, that pre-merchantable timber piece? And so we're going to figure that out by coming up with a fair market value approach for each of the assets, adding them up, and then redistributing it proportionately. So here's an example for you. I purchased the entire property for $100,000. The land, comparable land, would run for about $65,000. The pre-merchantable timber, we look at that from either what would it cost me to get it to that point in time, or do a discounted cash flow analysis to get to that. And that's going to take probably some help from a forester to derive that value. The merchantable timber, I can do price times quantity times by species to kind of derive my merchantable timber value. When I add all that up, what I see is through this piecemeal approach that the whole fair market value was $125,000. Now, certainly that doesn't mean that I could sell each of those pieces for that, but it's a way to reconstruct, if you will. And this is a method that the IRS accepts as long as you have background for where these numbers are coming from. So we're going to take this initial determination, and we're going to calculate a percentage of the total fair market value that each asset brings to the table. So if I look at this middle column here, you see the fair market value for my merchantable timber was determined to be $50,000. $50,000 out of the total of $125,000 is about 40%. So what we're saying is 40% of the total constructed fair market value is attributable to the merchantable timber. And I can do that with the three assets that I'm looking at here, the merchantable timber, the land, and the pre-merch, and it adds up to 100% of the total fair market value. So then what I'm going to do is I'm going to now ignore kind of that fair market value column. That's not the important piece to me. The important piece is taking those percentages and applying them to my total purchase price. So I paid $100,000 for the total property. What I want to do is take 40% times 100,000. It's going to tell me that I should put $40,000 in my merchantable timber basis account. Okay, and so I'm going to do that for each of the assets, and they're going to total up my purchase price. So what this means, if you're looking at this screen, is if I had done this calculation and then I had sold the timber, so I put $40,000 in the basis account for the merchantable timber, and I sell it the next day for $50,000, then I'm going to have a $10,000 gain. That's kind of what this calculates out to. All right, so that's all well and good. And some of you may say, oh my gosh, I don't know my basis, so I'm going to have to go find it. I'm going to have to go, or I know what I paid for it, but I've never thought about breaking it out. And what do I do now? And so this is not abnormal. This usually comes about when somebody's selling timber or when we have something like a loss situation. And so this is known as a retroactive basis determination. You're going to kind of back up to what did it look like when you got it. So I purchased it in 2000. I need to back up to 2000. I know in 2000 what I paid for it. Now I need to figure out in the year 2000, what were the timber prices so that I can figure out what the timber might have been worth. So what were the timber prices? Just about how much timber volume was out there. Maybe there's an inventory that you can find from close to that time of purchase, especially out here in the West. If you can find an inventory within a couple years either side of that purchase, that's going to be great for this purpose. This is just an estimation to kind of break it up. All of this is going to require a little bit of research. You may need to pay somebody to help you to recreate this basis. So if I do not know timber prices, I might need to talk to a consulting forester. I might need to talk to a stewardship forester to see if they can help me. If I reach out to a consulting forester to help me determine these values or to do my allocation for me, this is something that you're probably going to have to pay for their services. You might need some help getting some volume estimation. There is a way to back up into the volume that was standing previously. So if we're sitting here today and I have standing timber, or I have even the burned standing timber, a forester could come out, take a look at what's out there today, do some backwards determination to kind of figure out at the time you acquired it what that timber might have looked like in order to establish your basis. If you're in, so all that was if you bought a property and there were trees already on it. Some of you may have bought it, harvested it in the meantime, and put new trees in the ground, or you bought land that had no trees on it and you put trees in. The basis in those trees is going to be whatever it cost for you to establish that stand. So that's the purchase of your seedlings, or seed if you naturally seeded it, any of the site preparation that you needed to do. It is not the cost of your own labor. So if I pay somebody to plant the trees, that is part of my basis, but the cost of planting your own trees is not included in this. Excuse me. All right, so I want to stop there for a minute and let Carrie take a peek and see if there's any questions on basis. One other note I should make on this kind of basis part on the newsstands is if you have put new trees in the ground since, let's say, 2004, and you took the reforestation incentive at the federal level, then you likely have no basis. And we'll talk about that when I get to the point of reforestation. But this is the general rule for basis determination for a new stand, and then there's obviously some other rules. So,
so Tammy, we do have a question related to basis, and I encourage you all, now's the time, if you have a question related to basis, get those in so that the rest of the presentation is clear for you. So there's a question, is it safe to say the basis is 0 on the timber if one bought the land after a total burn?
Is it safe to say the okay, so nothing is ever simple. Let's just say that. Okay, and so if you cannot get anything for that timber, right? So if that timber was a loss, if you look at it and nobody can harvest it or nobody will take it from you, then that would probably be a safe thing to say, is that there's no basis in it. I'm trying to think if there's any reason completely burned, unsalvageable timber would have a basis. Because I think even the cost, I bet that somebody could probably argue that they could take costs to remove that timber from that particular area and attribute that to the next stand as reforestation expenses. So the issue here is in some cases, there are people that are a little bit more aggressive and people that are a little bit more conservative in how we do things. I tend to be a little bit more conservative on how I do things. And so I could see where some people would say that I would put basis, no basis on the stand because it's more conservative to put it all on the land. It is less conservative to put it on the next stand. And the reason you would want to put it on the stand versus the land is I can recover basis on trees faster than I can recover basis on land. So if I was looking at a burned stand and I thought maybe I could take the costs of removing that stand and put it in the next stand's basis, then I can recover that sooner than if I put that as a land cost. So I'm probably talking a little bit in circles, but there are several ways to think about this.
And Tammy, taxes is totally not my thing. So if you've already answered this, I'm sorry, but can you take a loss on that if you're actually paying to have that timber removed? And this is the same person who asked that previous question. I think you mentioned that.
Right. And so I think the question is, if you buy it, can you take a loss on that burned timber after it's already, yeah. So you're not going to take a loss on it if you don't allocate basis to it. Part of the thing to think about is how the IRS is going to view this, right? And in everything you do, I would ask you to think like an auditor at some point, right? If you're sitting there with an auditor, do you think you could convince the auditor that what you did was not just for tax avoidance, that you were doing this because this really made the most sense? And so I see that Megan is saying I answered her question totally. But yeah, but I think the point is there are multiple ways to look at the situation, and some tax preparers are a little bit more willing to push the envelope, and some may say this isn't even pushing the envelope to do this. And there are other ways to take those expenses off as well that might be outside of the casualty. So you take this as a management expense, right? So there are different ways to take these things off.
Great, thank you, Tammy. So if you have questions on basis, get that into Tammy right now. Tammy, for clarification, let's go back. Somebody asked, you did cover this, but let's just clarify here. You may ultimately cover this, they say, but are the Oregon wildfires defined as natural disasters or a qualified natural disaster? The qualified natural disaster removes the 10% of AGI deductible as compared to a natural disaster. So I guess the question is, was it qualified natural disaster or natural disaster?
That's a really good question, and I will have to look that up. That is a distinction I had not noticed. Again, that 10% of AGI is only on personal use for the casualty loss. And I should have said this kind of a little bit more up front. I'm a forester who studies taxes, who makes a living talking taxes, but really in that forestry vein. And so the personal use, I don't tend to get into that part. And so that distinction, I'd have to go look that up. And so I don't have an answer. If you need that and can send me an email to that effect, I will look for that.
Well, and Tammy, I'm going to also just announce here that we have Daniel Lavelle on the line. Daniel is our new Extension State Fire Specialist. Daniel, if you're still with us here, did you hear whether it was qualified natural disaster versus natural disaster?
So Carrie, I'm looking that up right now.
Okay.
So I'll try to get an answer for you in a few minutes.
Awesome. Thank you so much, Daniel.
And that's why I love Daniel.
Right.
Daniel.
I know.
I do see this other question on here.
Great.
About
go for it.
Original basis, and was the basis changed when trees were logged in 2005? And so let's talk about that for a minute. So let's say you had a stand of mature timber and you harvested it in 2005. Great example. So I harvested it in 2005. The basis would have been recovered at that point in time. So when I harvested in 2005, I would have used that original basis to offset the gain on that particular harvest. When I put the next stand in the ground on the same acre, I put new trees in the ground, I have a new basis. So this is that basis on a new stand part. So if I bought it previously and then allocated the basis, logged that stand in 05, that basis went with those trees. I should have recovered it at that point. If I did not recover it at that point in time, you have lost the basis that should have been allocated to those trees. So you can't amend that far back. We can only amend 3 years, but you would have a new basis in that stand. The only difference would be, so it would either be sitting there as basis right now on that now 15-year-old or 14-year-old stand, unless you took the reforestation tax incentive, and we'll talk about that in a bit, but that incentive allows you to kind of expedite getting that expenditure taken off your tax return.
Great.
All right.
So I don't see any other questions related to basis.
Great. All right, so we will move on. I want to make sure, what are you seeing, Carrie? Did I go back?
You did go back. So,
okay.
And that's your, okay, that's perfect. Yay.
Awesome. Great. Great, thank you. Okay, so let's move on from this basis. Okay, so when I was talking about the limitations for casualty loss, remember, I'm going to say this over and over, that you're limited to the lesser, the decrease in fair market value, which, you know, almost every time that's going to be larger than your basis, unless you just bought merchantable timber. So if you bought merchantable timber in the not too distant past, your adjusted basis might be higher than in most people's cases. But what I said was it was the adjusted basis we were looking for, and everything we just did was really the original basis. So the adjusted basis is taking that original basis amount, and then we're going to take off what we call depletion. And depletion is just a fancy way of saying the recovery of your basis if you have a harvest. And we'll talk a little bit about that in a minute. But it's that original basis minus any recovery of your basis due to a harvest, called depletion. If this was a tractor, you would have depreciation. So if you depreciated that tractor some amount, so the tractor's basis would be the purchase price, and then I would take off any depreciation for that tractor. But we're also going to add in, so adjusted basis isn't always just reduced, sometimes it's added. And so you might have some capital improvement to it. So with that tractor, maybe you have put in, and I don't know anything about tractors, but maybe it's a new motor. So that new motor is a capital improvement of it that would add to the basis of it, or any additions for any reason to the asset. Okay, so that's what we're talking about here, is the adjusted basis. All right, as we start thinking about how we're going to recover expenses, so basis is really just allocating your expense, if you want to think about it that way, the original investment, the expense that you put up front for acquiring the property, or if you got it through an inheritance, you know, that kind of, I didn't sell it, so that is my expense, and it is, I could have sold it and got the cash and I didn't. So with timber, we recover our basis through something called depletion if you purchase it or inherit it. Okay, and so I want to put that word in your mouth instead of depreciation. A lot of people think about depreciation. The difference between depreciation and depletion is how it's recovered. With depreciation, so if you think back about that tractor, as soon as I start using that tractor, I start depreciating that tractor. So I paid $10,000 for it. I immediately start writing off that tractor as I'm using it, either in units of production method, or I'm depreciating it over a scheduled period of time. We do the same thing with like a work truck. You start just kind of depreciating it to the point where you have nothing left of your basis. That's how you recover the expenditure. With timber, we only do this when we have a harvest or some kind of event. In this case, it would be a loss event. But we're only going to recover the timber basis through depletion. So we're going to recover it in proportion to the volume sold. So let's take the casualty out of it for a minute. If I have timber and I'm ready to start harvesting it, and I'm going to do a partial harvest, then I'm going to recover part of the basis, and I'm going to do it in proportion to what I sell of the timber. So if I sell a third of the volume that's out there, then I'm going to take a third of my basis to offset the gain on that sale. So I sell the timber, I take a third of my basis to offset that. And then that's going to be, what's left is going to be what I pay tax on. If I sell the entire stand of timber, then I'm going to take my entire basis in depletion at that time. If I don't sell timber in a year, then I don't take any of that basis off in that year. That's what's different from depreciation. And so if it's just really important to keep that distinction in mind. When you say depreciation, landowners, if you go in and a tax preparer starts talking about depreciating your timber, make sure that they convert over to depletion, because it's a different process. And so don't assume they mean depletion. Make sure that everybody's on the same page. And that's not an indictment on anybody that does not know the difference. It's just a function of not all tax professionals are working in timber accounts. And so just making sure that they're got that process understood. And we have some resources we'll tell you at the end that are great to pass off to tax professionals who are helping you, who may not be familiar with timber accounts. If you put the trees in the ground yourself, not yourself, but if you plant a new stand, we're going to either deduct those expenses up front and then amortize them through that reforestation amortization. Or if you don't do that, it's going to be in that account. You'll go through the depletion process later. All right, just real quick, I want to talk about the different types of income because we really need to process the gain part because there is potentially going to be some gain for some of you. So there are two types of income. There's the ordinary income that's going to come mostly from your wages, the typical rate schedule that you're used to seeing and hearing goes up into like 37% for top income earners. And then there's that capital gains type of income. And that capital gains type of income has lower rates. Currently, they're 0 if you're below a certain threshold, a 15% and 20%. They don't line up perfectly with the ordinary income tax brackets, but they're fairly similar. The people that are in the lower income, ordinary income brackets are going to have capital gains rates at that 0%. The 20% bracket is going to hit the high income earners, the 37% bracket, roughly. One of the other key parts of calling it capital gains is going to be the fact that you have no self-employment tax. That's a 15.3% additional tax that you would pay in addition to the ordinary income tax. And then, of course, capital gains can be offset by capital losses. So if you think about it, if you have capital losses from stocks, you can use your capital gains and capital losses to offset each other. If you don't have capital gains income, those losses can only offset about $3,000 of ordinary income. So this is what matters really from a gain standpoint. Again, by the time you look at what little loss you're going to be able to have, if you're able to salvage or get some insurance proceeds, a lot of people are going to find that they're in kind of a gain situation. So let's talk about how to treat it. If you've held that timber for more than a year, you're going to be able to call that kind of in that capital gains category. If you bought it as a gift, you're going to add up how long you held it, how long the donor held it, and that's going to, as long as that crosses that year threshold. And then if you inherited it, we're not worried about that time period. So we're looking at this in order to be able to categorize it as capital gains treatment. So let's put all these kind of pieces together, the income categorization, the basis, and what's going on in this part. So if I have a clear-cut timber sale, and I need to make sure we're very clear about what we have here. So we're going to take all the trees off of this particular area, all or substantially all. There is some non-merchantable stuff that's there, that's fine. But we're talking about removing all the merchantable timber off of the area. And we're also talking about having someone come in who is going to pay you for all the timber. This is not that you have a logger coming in who's working for you. This would be the situation where you've contracted with a mill. The mill's going to buy your standing timber. This is very, very common in the Southeast and in parts of Oregon, where that's a contract to sell the standing timber. And that needs to be differentiated. So we're going to receive $65,000 for the sale. My numbers aren't realistic. That doesn't really matter. It's about the process. We have some sale expenses, and then we're going to talk about having this kind of ordinary income bracket of 35% and a capital gains bracket of 15%. We don't want to forget about the basis. So we've gone through the motions of putting that basis account together for this stand. We have $15,000 in the basis account. The reason you needed to know this was a clear-cut sale is because it's a clear-cut sale, we're going to remove all the value out of this basis account. So that basis account is going to be completely used because we're going to cut all the timber that's tied to that basis account. So we have the sale proceeds of $65,000. We have some sale expenses of $5,000. and then I'm going to take the basis of 15,000 and end up with a $45,000 taxable gain. A couple of places mistakes happen here. People forget to take the basis out, and that would be a pretty big mistake. If you've done that in the past, you've got 3 years to fix it. Make sure you fix it. Forgetting to take the expenses out of it would be a mistake as well. If you have expenses like a cruise to sell the timber, you want to get those expenses out. As well as in the case of a standing timber sale, you're going to have some logging, maybe some logging expenses in there, road expenses, anything that you can allocate to this you want to remove at this time. And then the other mistake is calling this an ordinary income sale. So that $45,000 gain at a 15% or a capital gains bracket comes up to $6,750 in taxes paid. If you had put this in as ordinary income, you'd have a higher tax bracket, that 35% tax bracket, plus you'd have the self-employment tax on top of that. So you can see that comes kind of a large mistake at some point.
Tammy?
Yes, ma'am.
I hate to interrupt you, but I don't also want to go too far that we lose this question. Someone didn't quite understand in the part a couple bits ago about deduction and amortization if you started the stand. Could you repeat that?
I am going to cover that later in a different part. So if we can hold that question, I'm going to talk about reforestation expenses, and it's pertinent for that.
Perfect.
Great, thank you. There we go. Okay, so what we're going to do, and I talked about this a little bit already, to recover our timber basis. So we saw it happen here on this slide because we took all of it. Now we're going to talk about when we don't cut all the timber. So again, we're doing this through the process called depletion. And the way we calculate depletion is we're going to take that adjusted basis. There's that terminology again. So that was the original basis, adjusted up or down for either things I've already taken off or money I've put back into the system. So we have that adjusted basis, and we're going to divide it by the total volume of timber that's out there. So if I was doing this before a sale, which is what I would really need to know it, what I would do is I would figure out the total volume I had out there that was in that stand, and I would divide my adjusted basis by that total volume. And that's going to give me a per unit, $1 per unit sold depletion amount. And we're going to calculate that for each account. When I say that for each account, you could have set this up with a whole bunch of accounts based on maybe the age of the stand. It could be that some of it was maybe a hardwood stand versus a softwood stand. Maybe it's a more valuable, like you have a stand of timber that's veneer quality or poles. And so you want to differentiate that in different accounts. So we can do that as well. So you're going to do this depletion account calculation for each of those separate accounts. Now, technically, you should have that depletion account number ready at just about any time, but you can see that the timber keeps growing. That would mean you would almost need to redo this number each year. You don't need to do that. I recommend that you do this occasionally. If you have an inventory, go ahead and calculate at that point in time. When you go to harvest, when you go to put the timber up for sale, hopefully you've run an inventory to know what you have out there available for sale. And at that point, you would know that total volume of timber that was available. All right, so let's look at a partial harvest. Again, we're going to talk about selling it on the stump, although that's just part of the facts here. So we're going to have a partial harvest. We have an adjusted basis. So in the basis account is $5,000. And I know that out there total is 800 tons. So excuse me while I slip into more of a pulpwood type of thinking. 800 tons is out there. So if I do this calculation, $5,000 divided by 800 tons, I get a depletion unit of $6.25 for every ton that's sold. So this means as I start selling timber, I'm going to subtract $6.25 for every ton that I sell. That's my basis or my depletion adjustment. At the same time, let's just understand that every time I use that depletion dollar, I'm reducing what's sitting in the account available for future harvest. All right, so let's look at the sale when it's a partial sale. So I had 800 tons out there. I'm going to sell a third of those tons, or 267 tons. And I get $3,204 for the timber. And then I have some sale expenses. So if I take that 267 tons that I sell, multiply it by my depletion unit of $6.25 per ton, I come up with $1,669 of depletion that I'm going to take on this sale. So this is my recovering my basis, or getting my dollars that I put in back out to reduce the sale. So I sold it for $3,204. I'm going to subtract the $1,669. I'm going to subtract my sale expenses, and I have a taxable gain of $1,215. So that's kind of how that's being used. Now in my spreadsheet, or in my accounting system, I'm going to now reduce my total depletion amount, my basis available for use, by $1,669. So I have that much less available for the next sale. Now, when I go to the next sale, just kind of understand that if I go back in there in 10 years and go do another sale of some kind, the timber has grown and the dollars available have not changed. And so that depletion amount, that unit, that $6.25, will be lower because I have more volume divided into a lower dollar amount. You're not being cheated on it in any way. It's just proportionally stretching it out. That means every sale you'll be recovering some of your basis. And until you completely harvest the stand, you will not have completely recovered the basis. All right, so here's a little bit of a different situation. So previously I told you we were selling the standing timber. Now we're going to sell it differently this time. So this is a case where either the landowner cuts it or the landowner hires somebody to cut it on their behalf. And so some of this sounds like it's hard to tell. In the previous example, typically what would have happened is the mill would have sent somebody out, a procurement forester. They would have bought the timber from you. And then getting the timber off your property was something that somebody else did on behalf of the mill. In this case, when they talk about the landowner cutting it, or an agent, the landowner is actually contracting with the logger to do the work. So the logger is a contractor for the landowner, and then the wood is being sold, the log is being sold to the mill at a different point in time. Excuse me. Okay, so in this case, what we have is called a 631A sale. And what we're going to have to do, this has to be elected. We're going to elect to treat the cutting of the timber as a sale, so that we're going to break this transaction into two pieces, because each piece is going to be treated differently. When I was selling standing timber, the code allows us to think of that really as a capital asset. When I sell the log, now I'm selling something that looks more like inventory or a product. So it's got that value added because it's already down. And so because of that, it's going to be treated like ordinary income. And so 631A allows us to treat the standing timber, all the growth that went into growing the standing timber, as one part of the sale, so capturing the gain there in a capital gains way. And then the transaction that is from the sale of the log to the mill as a different transaction that is going to be treated like ordinary income. So it's breaking it up into two pieces. So like I said, it's going to break it into two segments: gain from holding the standing timber, and then the value added by conversion into a product. So on this first part, the gain from holding the standing timber, we're going to deem it a sale of standing timber to the owner by himself or herself for the fair market value before cutting. So I'm going to think about it on January 1. What was the timber worth on January 1? And I'm going to sell it to myself on January 1. And that's going to be my capital gain transaction. So the capital gain is the fair market value on January 1 minus my basis in the timber. And I'm going to do all this in writing, and I'm going to document how I got there. Now, you're sitting here today and you're saying, I don't know what it was on January 1. I didn't go out there. I didn't anticipate selling it. That's fine. You can back up into what it was January 1. The change in value wasn't from January 1 to September, was not really so much from growth as it was from market changes. And so what you're looking for now is just the prices on January 1. And if you know the volume that is available or was standing in September, you can pretty much assume that there wasn't much change in volume from January 1. And you're going to do all this in writing. So new basis in the next part is what I sold it to myself on January 1 for. So on January 1, I came up with a fair market value, sold it to myself. That's my new basis. So in order to figure out the second half of the transaction, it's the sales price to the mill minus my new basis is going to give me the ordinary gain. And of course, I failed to put in here, but of course, any expenses associated with harvesting the timber would be in here as well. So looking at a quick example, we're going to cut some timber in 2020 that from a tract that was purchased 5 years ago. That just basically is to say that you've held it long enough to go capital gains. I missed a date. Logs were sold in 2020 for $9,600. That's going to be that sale to the mill. And then you have a fair market value of $7,500 on January 1. You see a basis amount of $1,460 and then some harvest expenses. And we're going to make that election. All right. So we start deconstructing what happened here. On January 1, I said it was worth $7,500. And I'm going to document that by showing the volume and then where I got those prices from. I'm going to take off my basis. So if I sold all of it, it's whatever was in my basis account. I told you that was $1,460. The gain from growing the timber was $6,040. And that's going to be a capital gain. That's really where you want the bulk of the sale to land, right? Because that is going to be your lower tax rates and not pay self-employment tax. So we want that to fall there. The back half of this sale, you see the sale proceeds. That's what the mill paid me. The mill paid me $9,600. I have a basis in the timber of that January 1 value of $7,500. I have some sale expenses, and that all ends up with an ordinary gain of $600. Again, this is exactly kind of how I'd like to see this transaction lay out. The big gain is on the capital gains rates. The lower gain is on the ordinary income rates. Of course, you could see potentially a loss on that second part, depending on what's happened to markets and depending on what's happened to the value of your timber. So on January 1, before it burned, it might have been a higher value product. By the time you salvage it, it might be a lower value product. So you sold it to yourself, but by the time you sell it to the mill, it's no longer worth the same amount. So it is potential to have that situation happen. Of course, I have to mention that there is another tax associated with this. When you go into capital gains, that Medicare tax on net investment income, if you go over $200,000 as an individual or $250,000 for joint, it's an additional 3.8%, and it's going to be, if we looked at that 631A, it's just going to be on the capital gains portion. And specifically, if you are doing this as a passive activity. So it's really important that if you are not in this as an investor, if you are really trying to make a profit and grow the trees, that you're documenting what you're doing along the way so that you're seen to be actively engaging in the management of the property. So Carrie, I just want to do another check and see if we had any questions on this part.
Just one question, and that was just if there was software to help with these records and calculations.
There is not timber-specific software that I'm aware of. There may be, I have heard that some of the tax preparation software has some of this built into it. But I don't know how well it works. I learned when you all tell me that, man, that was really hard to use or didn't ask good questions, or I didn't know what to do with this because it didn't ask me about this. So unfortunately, that's the answer, is there isn't a forestry specific one. It might just be built in. It's something that needs to be worked on, and maybe this is the impetus that I need to put something together from, even if it's a spreadsheet that could help you kind of work through some of this process.
Mm-hmm. And then somebody else just typed in, maybe think of the $600 gain as a profit.
Sure, right. Yeah.
Okay. And then just to update you all, so Daniel Lavelle has a call-in with the Oregon Emergency Management to ask that clarifying question versus a qualified natural disaster versus natural disaster. So hang tight. Hopefully we'll get that answer by the end of the webinar. If not, we'll make sure that it gets to your inboxes. Great. That's all I see for now, Tammy.
Thank you. Thank you. Okay, so wow, that's already a lot of material, and I understand that. And I will tell you that I have some resources that can help you get through that basis piece in a little bit slower manner that kind of really digs in. So if there are pieces of that, you know, I was trying to hone in on what would really be critical for today. I've got some resources. You can sit down and watch a video kind of walking through this a little bit slower, as well as kind of dealing with the income side part of it. All right, so we're going to move on next to some of these financial assistance situations. And so first I want to make sure everybody's on the same page and kind of understands what cost share is. Cost share payments are usually, in a lot of cases, funds that come from a federal source that have, in a lot of cases, trickled down to a state level. Sometimes they are state level dollars, but in the big programs, they're coming from federal programs, usually like the Natural Resource Conservation Service. But they're flowing down through those agencies to your state agencies. And you are looking for, they really are what they sound like they are. They're cost share. So they are sharing the expense of doing certain treatments or certain things on your land. And each program has specific goals. In most cases, these programs are conservation oriented. There are some that are more wildlife centric. There are some that are more forest health centric. So that might be reducing the number of stems if you've gotten into an overstocked situation. Realizing that overstocked situations can be bad from a fire standpoint. They can be bad from an insect and disease standpoint. So these cost share programs are put in place to kind of help you with the expense of doing things that are generally seen to be good for conservation purposes. And so to get these dollars, you would go to your NRCS office, the Natural Resource Conservation Service office, or to the Farm Service Agency office for certain programs. And they have certain guidelines for what they need you to do. Almost every situation requires a management plan when we're talking about forestry. So you go in with a management plan, and they each have their own kind of rules on what you can do to qualify for that program. And then within that, they have set dollar amounts that they will give you for certain operations that you're going to do. So if you're building a duck impoundment for a wildlife program, there are certain dollar amounts that are attributable to something like that they will give you. So it is some sort of a cost share. And so the reason I bring cost sharing up and making sure you understand it is those dollars are available. Sometimes they're available for reforestation. Sometimes they're available for reducing fuels on the ground. And again, sometimes it's for those insect and disease issues. If you get those dollars, and they can be hard to get in some places, so I will be upfront about that with certain counties, because it is administered at a county level. So the state will have its own program goals, and then the county will divvy it up themselves once they get their dollars. And depending on how broadly construed the program is, agriculture may be in that program, ranching may be in that program, and forestry may be in that program. Some counties that are heavily populated with farmers and ranchers will see the dollars go very rapidly. People that have gotten it before know about the programs, and they're pretty quick to get there because they know they're going to run out. Other counties, you may have a little bit more time to work with. So when those dollars become available and you get them, and you usually get them with some kind of contract involved of what you need to do in order to be meeting the requirements of the program. Everything in the income tax code says that any money from any source is taxable until we start excluding it. So if you start from that standpoint, that all the dollars you get from any source are taxable. And then we start looking at different code sections that allow us to exclude or treat it differently. So with cost share payments, there is a code section specifically for that. I have not used any code sections yet, but for those of you that like numbers, it's section 126. And this section 126 deals specifically with cost share payments. And what it says is that you can qualify to exclude part or all of a payment that is received from cost share purposes. It has to be a payment determined by the Secretary of Agriculture for conservation purposes. And those programs, if it's a standard program, EQIP is one that comes to mind, the Environmental Quality Incentive Program. Those dollars almost always qualify for cost share exclusion or partial exclusion. Other programs that, especially if the state has taken dollars and decided what to do with them, they then have to go from the state. The state has to ask the Secretary of Agriculture to determine that payments for conservation purposes. And then it goes up to the Department of the Treasury Department at federal level to qualify for this. It's a long way of saying there's no real easy list to find which programs qualify. So you could ask and maybe you'll get an answer on if that program qualifies. You can always include the payment that you get in taxable income. You will not get an argument if you include it all. However, you would like to exclude it under most circumstances because it is income. So the payment that you receive has to be for something that's considered a capital expenditure. So we didn't talk about capital, but capital expenditures are things that are long lasting, so they're going to last more than a year. They're considered an improvement, not a maintenance expense. So if I were to talk about roads for a minute, which is always a little bit of a touchy topic, if I fill in a pothole, that is a maintenance type of expenditure versus putting in a new road would be something that's more on a capital way of looking at things. So if I'm building something that's going to have a long-term life on the property that I got cost share dollars for, then that's going to qualify for this. If you're allowed to deduct the expense, so you do something, you do an operation on your property and you're normally allowed to deduct it, then you're not going to be able to exclude the income. So basically, if you take it off your tax return in one place, then you have to include the income. If you don't take it off somewhere, then you'll be potentially eligible to exclude part or all of that payment. Now we're going to get to reforestation here in just a minute, but if you deduct your reforestation expenses through the provision, then you can't exclude any cost share dollars that you get for reforestation. So sometimes we have programs that are trying to get people to plant certain species. And so you might get cost share dollars to plant a specific type of tree. If you get those cost share dollars to plant a specific type of tree, you're going to need to either not deduct the reforestation expenses or include the income. So it's one or the other. You can't have it both ways. So if you get the cost share payment and decide you want to exclude it because you feel like you qualify, there's this calculation that you're going to run through. It's the greater the present fair market value of the right to receive this annual income. It's 10% of the average annual income for the 3 tax years immediately prior. Now, if you haven't harvested anything, that's big fat zero. So in that case, it's the larger the two numbers, the bottom number is the bigger one, the amount equal to $2.50 per acre times the number of acres that receive the cost share. And so you're going to take either of those numbers, whichever the greater one is, and you're going to use the interest rate from the Farm Credit Bank on the bottom. You can find this calculation if you look it up, and I have a video that can walk you through kind of that if you have that question. If you do exclude it, you're going to have to include with your tax return a statement showing the total cost of what you did, the amount of cost share dollars you received, when you got the cost share dollars. That's going to help them figure out which tax year that we're going to put that in, what the purpose of the payment was. The purpose of the payment was because you were constructing a duck impoundment and to encourage more ducks to use the property. And that payment was to help offset the expenses of that. the amount that you excluded, and then how you determined that particular amount. So this is something you're just going to include with your tax return so that you can kind of show why you were excluding it. All right, so here's the more fun part, the part that will help get you some tax break going forward. Reforestation, when we look at it from an income tax standpoint, they kind of define it to be afforestation, which is taking ground that never had trees on it and putting trees on it, or doing reforestation. So you've had a harvest or some loss of timber and you're putting trees back in that place. And so the expenses that are kind of associated with that are going to be any kind of site preparation. If you buy seed or seedlings for this, any brush or weed control that you can't deduct. And it doesn't matter whether you're doing natural regeneration for those of you that aren't required to do it, or artificial regeneration. So the manner of the reforestation doesn't matter. And one thing I should say, what is not included in here in the expenses is your own personal labor. So if you plant the trees yourself, you cannot infer what that costs for you to plant the trees yourself. So just know that that's in there. I will also say that for those of you in states where reforestation is required, such as Oregon, the federal government, the IRS, does not differentiate between whether you reforest because you wanted to or you reforested because you were required by law. So the fact that Oregon law requires you to plant does not stop you from taking this incentive. So what is the incentive? This is the really good stuff here. It's the outright deduction of expenses up to $10,000 per qualified timber property per tax year. So this allows you to expend up to $10,000 and then just write it off on your next tax return. So it would be written off. If you did this in 2020, you would go ahead and write that off on your 2020 tax return. So it would be a deduction. And this is not in your miscellaneous itemized, those things that went away. This is a different part of the tax return. So for those of you that are tax preparers or just like to know the numbers, this is called a Section 194 deduction. So per qualified timber property, that definition has never been made by the IRS on what that actually means by per qualified timber property. So there are really two ways of looking at this. You have a really conservative way of looking at it, saying, okay, I have one property, it's all under the same management plan, and I'm going to go ahead and that's going to be one qualified timber property. If you, within that management plan, start separating out and you have where you're talking about the management of this age group or this particular stand, and over here you talk about other stands and other age groups, and even though they're actually doing the exact same thing, you have a plan for them that has been written up and you keep the accounts for them separately. So when we are talking about breaking out basis into accounts, if you keep the accounts separate, that will allow you to think of these potentially as two different timber properties. Of course, if you have property A in Lynn County and property B is in Lane County, then that becomes really a lot clearer that those are two qualified timber properties. So don't think of it as just the tax lot, because sometimes the tax lot is just happens to be legally where the line came in. That isn't really what's going to come into play here. Per tax year, as long as this stays in the tax code, you can do this every single year. So we're sitting here at the back end of 2020. If you were to go get things done between now and the end of the year under this reforestation incentive, and then needed to do some more next year on the same patch of ground, now you're talking about 2 tax years, and you can do this times 2. Now you're gonna have to do a little bit more keeping track of that, right? You're gonna have that in 2 separate tax years. You're gonna have to do it on 2 tax returns. And keep in mind, it's up to 10,000. So if I only spend 8,000, I only get to take the 8,000. If I go over to the 10,000, so let's say this year, I did a whole bunch of reforestation and I need to do some more on the same qualified timber property. Anything that goes over the 10,000, we're going to amortize over the next 7 tax years. Basically, it's a fancy way of saying we're going to write it off over the next 7 tax years. So what that looks like in practicality is you're going to take 1/14 this year, what's left of this year, you would take 1/14 of that amount that went over 10. Next year, you would take a 7th. And then that last year, you take the final 1/14. And by the time that's over, you've recovered all of your reforestation expenses. They've all been taken off your tax return. Now, why is this a good thing? Because trees take a long time to grow. And if I leave all that, my other alternative is to put it in a basis account and it sits there until I start harvesting. In Oregon, we're talking 25 years for maybe 25, 30 years for a thinning, and then a final harvest out 40, 50, 60, whatever, or longer, right? And so if I think about what I could do with those tax savings, if I get them in this early part, they're worth more to me. I can put them in the bank. I can make a small amount of interest on that. I can go put it into another stand of trees versus waiting to recover it to offset gain in future years. Now, what that does mean, though, is if I recover all of it now, in 30 years when I do a harvest, I have nothing to offset the gain. However, again, I need you to keep in mind that money recovered today is usually considered to be more valuable than waiting many, many years to get those savings. So let's look at it real quick. I kind of talked a little bit about this. You spend $25,000 on reforestation in 2020. You deduct $10,000 on this year's return, take that $15,000 and amortize it. Now, I'm going to get another $10,000 deduction up to next year if I do some more activities. And so what I'm going to have to do is I'm going to have $10,000 on the 2020 return. I'm going to be running that $15,000 amortization account because I got to keep track of that. So I do it each year. On 2021, I'm going to have some amortization and I'm going to have a new deduction if I do it. And if I went over again, now I've got another amortization account to keep track of. It's not super complicated. It's just something to keep track of in a spreadsheet. There are, however, recapture provisions. Recapture is one of the nasty words in the tax code. If you sell the timber or sell the land with the timber on it within the first 10 years after taking this reforestation incentive, you're going to pay some extra taxes on the gain on the disposition. And some of the tax savings that you've gotten over the years, you're going to be paying back some of that with some penalties, potentially in interest. So just be aware of that. If there's a chance that you believe that you're not going to hold the property for the next 10 years, then maybe it's not in your best interest to go down this path. So some tax strategy on this stuff, because I think it's important to talk strategy, especially as you're making decisions. The reforestation incentive is available every year as long as they keep it there. If you're staggering your operations, you're doing some cleanup, you're doing some site prep. If you do that in 2020, and then in 2021, you put the trees in the ground, you've hit 2 different tax years, you have that incentive available in 2 places. This has to be done on a timely filed return. If you get cost share money for reforestation, you have to include the cost share money in order to take the reforestation off. And then you cannot carry over any unused deduction. And just remember there's recapture provisions. Carrie, we'll put all this up because this is just kind of where to take it from. Investors take it on the front of your 1040, businesses on your Schedule C or your F. And you cannot do this on an amended return. This is the biggest thing. All right, so we're going to shift gears into kind of the Oregon tax stuff. This isn't going to take us very long, but it is important to recognize that there's some property tax consequences for some of you, depending on what you decide to do. You know, we have this dual program here where you're either in the forest land program or small tract. If you kind of look down this, you know, obviously those that are in small tract are in it because each year they pay a lower annual tax. And in return for paying an annual tax that's lower, when you do a harvest, regardless of why you do it, you're going to trigger a severance tax. And so that's what we need to talk about now is that severance tax that's going to get triggered. So severance tax is volume based on the harvested timber. And obviously the intention was to recover that 80% that you weren't paying in the annual taxes. So what's taxed? Pretty much everything, all logs, chips, poles, pilings from land that's under this program. If it's smaller than 5 inches in diameter or it's chips that would be hog fuel, that's not going to get taxed. So just kind of to show you where we're at for 2020, if you're in Western Oregon, it's $6.15 per thousand board feet of harvest. In Eastern Oregon, it's $4.78 per thousand. And of course, this is indexed annually, so it changes every year. If you wait till next year, it's probably going up close to 3% because that's kind of what it goes up. Maximum value increase is limited to 3%. So if you can't get it harvested this year, you know the maximum amount that's going to go up is 3%. And it is due January 31st of the year following harvest. When you file notice that you're going to harvest with ODF, ODF turns around and there's a notification system to the Department of Revenue, and the Department of Revenue will be looking to you to pay your severance tax if you're in this program. In addition, everybody pays a forest products harvest tax. This is also a volume-based tax on all the timber that's harvested. The first 25,000 board feet is exempt, but after that, everybody pays $4.13 for 2020. So know that that tax will also be due. Due on January 31st, kind of like the harvest severance tax. What's taxed? Pretty much everything except for chips that go to hog fuel. Just to kind of make, I know that some of you are deciding whether you want to replant or not after the harvest. And so we want to get some things out there in front of you to consider. You have to complete replanting by the Oregon Forest Practice Act within 2 years of a harvest. Within 6 years of harvest, they have to be free to grow. And then there are some survival limits based on your site productivity, and you should really reach out to a stewardship forester if you have questions on this. The reason I bring this up is if you're trying to decide whether to do replanting or not, know that by Forest Practices Act, you're required to do it, but it also impacts your property tax. In order to stay in those property tax programs, you have to be following the Oregon Forest Practices Act. If you're not, you're going to be in violation. They're going to also kick you out of those property tax programs, and there could be consequences for those programs. I just wanted to put out in front of you that extensions can be made if there are extraordinary circumstances for why you can't get things reforestation done in the time period. Part of it's due to problems with inadequate seedling availability. We suppose that could be a problem coming up here because of the number of acres that need to be dealt with in the near future due to that wildfire. So you can see that because of wildfire or seedling availability, the state forester can change the timing of your requirement to do reforestation. I want you to notice, though, that the state forester does this decision based on evidence provided by the landowner. So this takes communication with your local stewardship forester to talk about what is a reasonable attempt to get things done in time, what do you have to do to stay within the requirements. So I just wanted to put that out there as you make these decisions on whether to do it or not. It goes to how this is going to impact your property taxes as well. So I just want to put some quick resources out here, and then we'll hit some questions. The Forest Landowner's Guide to the Federal Income Tax is a great resource. It's known as Ag Handbook 731. To be honest with you, it's always by my side when I'm trying to go through these type of questions. It's what the closest thing we have to a definitive guide. It is reviewed by the IRS. It is currently in revision. So anything that's happened since 2013, and I know it seems like that was a long time ago, there's some potential for change. And so, if you're in doubt, just use the power of the internet to kind of check on certain provisions. But what this will do is give you a starting point. Mostly what you'll see have changed is actual dollar amounts, except for the reforestation. That dollar amount has not changed. The casualty loss on a personal use, that is not covered in here because that's a relatively recent thing. But for the most part, everything else is going to stay in place as you see it in that guide. We are currently rewriting it, but it'll be a while. Also available online, you can search for the Hardwood Timber Industry Audit Technique Guide. It is an online IRS guide. Don't worry about the fact that it says hardwood. That just means all the examples are hardwood industry examples. But it was written by an IRS forester. So at one point we did have IRS foresters. The gentleman has a forestry background, but did work for the IRS. And it's written for the auditors. So the auditors, when they come in and they look at a forestry tax return, they have a little bit more of an understanding of the industry and specific sections that talk about forestry. And then I have some YouTube videos that I put up a few years ago that you can go to that discuss timber sale income, allocation of basis, the cost share calculation was in there, as well as the reforestation. Those were all done about the same time as this last guide, so 2013, 2014. But of course, if you have any questions, feel free to send them my way. So with that, my email address, like most of us, I am not working at the office, and so phone calls do not go directly to me. I get them later, so emails are usually the best. With a little bit of detail, all questions are kind of tough right now around taxes because a lot of things are facts and circumstances, and you could leave one sentence out that could tip the answer. So even if you communicate via email with me, we may be on the phone at some point to discuss it further. So, all right, Carrie.
Great. Okay. Well, you've got some questions already lined up, and I'm going to start with just a comment here. Somebody says that both the STF severance tax and the forest product harvest tax due date has been changed beginning with harvest in 2020. Date changed from January 31st to April 1st. DOR's websites are currently being updated.
Fantastic. That sounds like it's somebody in the know. So, but you should always check things.
Yes. Yes. Okay, here come the questions. What species of trees planted with cost share cannot be deducted, and how is that determined?
Trees planted with cost share. I'm trying to process the question. So cost share programs are very specific on what they're trying to accomplish. And so within those cost share programs, they're going to have rules that tell you what you can do to qualify. So I'm not sure on the species of trees. I think where I'm getting lost in the question is putting cost share and deducted and tree choice in there together. So cost share from a federal government standpoint, the federal government only cares if the cost share program meets the Secretary of Ag's conservation purpose and it's been approved. And so that may or may not have anything to do with the tree species. And so if that program like EQIP is on the list, then you are able to use cost share dollars that come through EQIP to do that potential exclusion. And so that doesn't have anything necessarily to do with the species. Now, the rules within a specific EQIP program may say that to meet our program goals, we're not going to allow you to plant oak trees. We want you to plant Doug fir or vice versa. And so that's the best I can do with that question unless somebody wants to redirect me on what they were specifically asking.
Right, we'll wait for that. If that comes in, I'll let you know, Tammy. But just a clarification on the severance tax and forest product harvest tax that I just mentioned, the date changing from January 31st. I had said April 1st, but there is a correction that it's April 15th. Check out, do your own searching and make sure that's correct.
Yes, absolutely. And so I have no doubt that the person who's posting this has some in the know knowledge, but always, you're looking for definitive guidance and you should be getting, hopefully you're getting, the form to fill out and it will tell you the deadline.
Right. And just to follow up on that question you were just answering about cost share and species, the person did follow up and said, or typed in, I thought you said if specific tree species are required to be planted for the cost share funds cannot be deducted.
Oh, yeah, no, the program may tell you what to do. And so if the program tells you what to do, you have to stay within the parameters of the program. And then the program is what's approved by the IRS, not you in particular approved.
Now, this person, I think, is referring to the Forest Practice Act. If no harvest was made, only the trees burned with no salvage, is there a timeline to have the trees replanted?
Okay, so I feel like we probably have some ODF people on here who might chime in. So feel free if I'm going to go where I think. So there are stocking rules within the Forest Practices Act. And so my guess is a dead tree is not going to count for the salvage, for the stocking level. And if it's not going to count the stocking level and everything is burned and it's all dead, then you're not going to meet the stocking level. If you don't meet the stocking level, you're not going to meet Forest Practices Act. That's my guess. And we're going to hope that maybe somebody from ODF will provide clarification on that. But this would be a great time to follow up with a stewardship forester. When I say stewardship forester, I'm really talking to someone at your local Oregon Department of Forestry office. If you're in another state, most state agencies have somebody available to talk to within your county. So you're what we might call a county forester in some places. Reach out to them. They are going to be your best on the ground resource along with your local extension forestry agents.
Perfect. So Tammy, is there a resource which shows tax preparers familiar with timber tax laws?
Unfortunately, there really isn't. Because we have no way of assessing that, we are not comfortable with posting anything like that because I could have a training, and I've certainly done trainings where I put 600 people through it. But the question is, I don't want to attest to whether they're familiar, how much they listen, how much they actually understood it. And they may sit one day and never do a return for 3 years. I would not want to vouch for their ability to do that. So we don't do that on the extension end. But to be honest with you, what I like to tell people is your best resource for a tax preparer that knows how to do timber tax work is to talk to another forest landowner. So this is going to your local county forestry association meetings, which some of them are being held virtually, which you don't even have to leave the comfort of your home now. But reaching out to those other landowners, if you're in the tree farm system, talk to somebody in tree farm. Most people are willing to share when they find someone that knows what they're doing, because everybody knows that the more returns that they do in this arena, the more familiar and the more they know what the interpretations are on some of these provisions, because some of these get kind of sticky. And, if you don't do it on a regular basis, you might miss some little nuance that's changed in an interpretation.
And then somebody asked, where do I find that guide? And I'm thinking they're talking about, you mentioned some guide. There you go.
This phenomenally captivating, put you to sleep at night guide, right? It's like watching the election returns right now. So this guide is not in print anymore because it's a federal document. And most people know that the federal documents they don't print near as many as they used to. But I'm holding it so hopefully you can see it. We can kill my screen share. There we go. So, and I guess I need to do the mirror thing in order to make this look better. So watch my roof.
No, that looks great, actually.
There we go. Okay, so this is the Forest Landowner's Guide to the Federal Income Tax. If you go into your internet browser and type that in, it will come up and it is internet accessible. You can point your tax preparer to this. They will be able to understand everything that's in here. It is written as much as it can be to the level of a layperson, as much as it can be. This is tax law. So it is not going to be perfect as far as being able to understand it. But you can search for that. You'll find it. It is dated 2013. So don't get nervous when you see that. That is what it is. Like I said, we're redoing it, but even in redoing it, we're not finding that it's wrong in most cases. It just needs some refreshing and some extra explanation on things like conservation easements. But a great resource for your tax preparer, because that will tell them code sections that they can then go look up, and they'll understand what they're looking at when they dig into it.
Great. I put that link in the chat box. I'm also going to email you that link, and I'm going to put it on the website, so you are sure to get it. Great.
Great.
I don't see any more questions, but I know Daniel popped on because he wants to update us,
Great.
I think, right, on the qualified.
Two things. I put it in the chat box that those are qualified disaster declarations by FEMA for those counties within that time frame. IRS issued tax relief based on those qualified declarations. So there's a number of tax relief measures that the IRS tapped on to those specific qualified declarations worth looking at. And they even give a limited relief outside of the declared areas, but you need to call them to find out. Real quick, I don't mean to take anything away, but on the question of species selection for EQIP, I know the NRCS EQIP process requires a conservation plan, and within that for cost share, and within that conservation plan, following these fires, species selection to site preferred species, site suitable species is part of that, and stocking level guides according to Oregon best management practices. So yes, it is specified, but it's site suitable. And it's part of the conservation plan.
Great. Yeah.
Thank you, Daniel.
Thank you, because that is very specific to the program itself versus the IRS saying something. And so, yeah, so thank you for clearing that up.
And just to clarify again, we're getting a question. So the fires are considered qualified natural disasters, correct? In some of those counties that Daniel listed in the chat box.
Yeah, really restricted, but yes.
So let me just see here. I know they're in the chat box, but that's for Clackamas, Douglas, Jackson, Klamath, Lane, Lincoln, Lynn, and Marion counties. FEMA declared qualified natural disasters for the time period of September 7th through the 15th.
Great. Thank you for clearing that up, Daniel.
Yeah, thank you.
You're very welcome. Thank you for a good presentation.
You're welcome.
Yeah, any other questions for Tammy while we have her expertise on the line? And I guess I'll take this moment to say thank you so much, Tammy, for providing that presentation. It was full of a lot of great information. We will have this available as a recording on our website. So look for that here in a couple of days. It always takes a couple of days to process. If there are no other questions, that wraps up our session today and concludes then the fire program post-fire webinar series. Coming up with Tree School Online is a webinar on replanting your forest after timber harvest or wildfire. So be sure to check that out on December 1st from 3 to 4:30. I believe Mike even put another webinar opportunity in December around fire. So check those out. I've already said thank you to Tammy, and I just want to also thank you all for joining us. Again, we recognize this is a really difficult time for so many of you, and we appreciate you tuning into these webinars. As you know, webinars are just one way we can provide information to you during this time of COVID. This webinar has been recorded. We put it live on Facebook, so check it out. And if you have a moment, please tell us what you thought about today's presentation by filling out a very brief survey immediately following the webinar. A pop-up window should appear in your browser as soon as you close out of this Zoom webinar today. I don't see any other questions pop up, so I'm just going to say stay safe, everyone, and good night.